think we are ready. I want to thank everyone for attending this Lunch and Learn event. I'm very grateful to our Rockefeller College staff members, Kelly Hammond, Renee Wallingford, and Lizzie Barlow, who supported this event. And of course, we would not be doing this without our loyal audience. I wanted to note that closed captioning has been enabled for this event, so each user should have access to the text either at the bottom of your screen or through the chat box. This information will also be shared in the chat function for anyone who needs to reference it later on. Please note as well that the entirety of this session will be recorded, and that will be helpful for anybody who wants to access this information later. Today we are going to be learning about the implications of rising interest rates. As you know, in March, the Federal Reserve approved the first increase since 2018, and additional increases will be coming. What does all of this mean? We are fortunate indeed to have a wonderful panel of experts to explain. I would ask you all first to welcome our moderator for today, Kevin Bronner. He's a public service professor at Rockefeller College. And before I introduce the panelists, I just want to thank Kevin for bringing this topic to our attention. This is the second time in the last year that a simple suggestion from someone in our community has led to a full panel and open discussion on a topic that really matters to our students, faculty, staff, and alumni. So thank you, Kevin, for the recommendation once again.
You're welcome, Julie.
And our panelists today will be Mitch Abalafia, who's a professor of public administration and policy here at Rockefeller, Associate Professor Jofi Barta, who's a professor in the political science department, and we're fortunate indeed to have Mike Murphy, who is the chief of staff at the Committee for a Responsible Federal Budget. And with that, I will turn the ceremony over to Kevin.
Okay, thank you everyone for joining. We're going to make this real direct. So we'll have each person speak for about 5 minutes, and then we'll have Q&A. And if you've sent in a Q&A already, I have it. We ask you to use the chat room to add in additional Q&As, and we'll be monitoring those. Now, we're really lucky, as Julie said, to have these great people on our panel. Mitch wrote a book, Stewards of the Market, How the Federal Reserve Made the Financial Crisis in 2020. Sophia wrote a book in the red, The Politics of Public Debt Accumulation in Developing Countries from 2018. And Mike's the chief of staff of the Committee for a Responsible Federal Budget. I've already been reading information from that organization in the Wall Street Journal. So we've got we have top people here. So with that, why don't we just start, and we'll go in order that in the program. We'll have Mitch, Sophia, and Mike. So please begin.
Okay, I'd be happy to. Thank you both, Julie and Kevin, for your introduction. What I'd like to do with my time is address some questions people might be having about the Federal Reserve, and especially its effort to fight the spike in inflation that's troubling all of us. As you've heard, most of this inflation is explained by 3 things. The supply chain problems related to the pandemic that have caused shortages of various products, an oil price shock caused by the war in Ukraine, and the fiscal stimulus used to support the economy during the pandemic by putting money directly in the hands of consumers. Some of you might be asking, what's the Fed got to do with inflation? My short answer is that the Fed has 2 main jobs, what's referred to as its dual mandate. The first is to try to maximize employment. The second is to maintain stable prices. Obviously, inflation is a direct challenge to that second mandate. After a long period of relatively level prices, that stability has been shattered. So given the dual mandate, it's really central to the Fed's job to bring down that inflation. That is the unwanted increase in prices for housing, food, and other essentials. These increases are particularly hard on the poor, the working class, and the elderly on fixed incomes. This leads to a second question. How does the Fed bring down inflation? The Fed cannot do this directly. Rather, it has tools that it uses to do this. In general, these tools are all involved making it more costly to borrow money. They do this by raising their target interest rate, known as the Fed funds rate. What they're actually doing is selling bonds in their inventory and thereby taking money out of the economy. money that might otherwise be used for loans by banks. The banks themselves raise their own interest rates since borrowing money is costing them more. As borrowing becomes more expensive, this slows the housing market, discourages purchases and hiring by firms, and eventually slows wage growth. The chain effects play out gradually so that it usually takes about 6 months before an interest rate move like the one we saw last week has its effect on the economy. So this suggests another question. Is there any risk in these interest rate moves by the Fed? And the answer is yes. The biggest risk is that the Fed will overshoot its mark and plunge the economy into a recession. That historically is the most common outcome when the Fed tries to control inflation. The Fed's goal is to reduce inflation without crashing the economy, but it's very hard to achieve what's called a soft landing. The difficulty is mostly a function of the 6-month lag that I mentioned. Last week, we saw the first of a predicted series of interest rate increases. Now, the question is how large and frequent the next increases will be. The problem is that it's hard to judge when to take your foot off the brake when you won't see the effect of your braking for 6 months. Historically, the Fed has rarely been able to achieve a soft landing, which leads to the obvious question, are we likely headed for a recession? That's hard to say, and at this point, most observers are reluctant to forecast that. If one judges by the Fed's record, at least a mild recession seems likely. Some observers think that the Fed waited too long to start raising interest rates and that now it will have to hit the brake pretty hard to dampen inflation. Also, the war in Ukraine is a source of great uncertainty. On the other hand, they might be able, I should say, to achieve a soft landing. The fundamentals of the economy are still pretty strong, surprisingly so. The unemployment rate is low, wages are rising, corporate profits are strong, and financial markets are recovering from a recent dip. So once some of the supply chain problems resulting from the pandemic are resolved and the oil shock from the war in Ukraine moderates, the economy may continue to grow, even with higher interest rates. It's still too early to say. The Fed is involved in a delicate operation calculating just how much restraint is appropriate. It's really more craft than science. That's probably a good place to stop.
Okay, I think I should take over. Thank you, Mitch. This is actually a great introduction to what I was going to talk about today, because I'm actually going to take a fairly different approach, and I have no, I can't actually get into predictions about a soft landing or a hard landing because that's just up in the air. But I wanted to introduce a new perspective as a political economist, because I think what I'm going to talk to you about is going to be very different from the analysis that you would get if you listen to somebody in the economics department, because in the economics department, you would have a clear explanation for how monetary policy works. Mitch has laid that out partly, but there is actually a previous question whether it's really the Fed who should be addressing this current problem. So what we have on hand is, as Mitch very usefully laid out, was this problem of inflation, which has in itself many related problems in terms of many related social problems for the poor, for the elderly, for people with savings, and so on. So we are all agreed on how this situation has to be solved. And I think there's also a fairly big or a fairly strong consensus what the sources of this inflation are. As Mitch was laying it out, there are supply shocks such as energy prices surging due to the end of the pandemic boost. There is a war going on. Manufacturing and trade are hit by so-called supply chain disruptions, as whole areas of manufacturing are currently shut down in China, around Shenzhen and Shanghai. Things are literally not being produced. Even if they are produced, they can't get to ports in the US. So on the one hand, part of the problem is that there is just not enough goods going around, and that has very tangible physical reasons. On the other hand, people say, well, the other side of the problem could be a so-called demand side shock, meaning too much money chasing too few goods. And the implicit reasoning behind that is that the stimulus made sure that people still have money at the end of the pandemic. And because they couldn't spend during the pandemic, now there's all this pent-up demand flooding the markets. And that's what's creating inflationary pressures. And the third thing that I wanted to also emphasize is some people are saying, okay, so these are temporary shocks. Maybe these would resolve themselves on their own. So supply chains eventually work themselves out. We could start a green transition, and then energy prices would work themselves out. If all the pent-up demand is satisfied, that would work itself out. So a year ago, there was this long debate whether this inflationary pressure is temporary or lasting. And by now, there is actually consensus. We all say it seems to be a lasting phenomenon for now. There are just constantly new and newer shocks, more lockdowns in China, more disruptions in shipping, and it seems like the demand side shock hasn't run itself out. But there's a third element that many people, and this is where people disagree, is that supply side shocks and demand side shocks, they give a one-off push to inflation, but that's not necessarily such a big tragedy, because even if inflation stabilizes somewhere around 5%, it's fairly high, but it's not the end of the world. What most people are afraid of is that expectations of rising prices are going to be built into what people say, how much, what kind of wages workers are demanding, and how producers are setting their prices. And the real danger here is if expectations are built into, expectations about rising prices are built into how these actors behave, then inflation can perpetuate itself and also accelerate through time, even without further shocks, even if the war in the Ukraine was resolved, even if COVID went away. And so there is a real danger, and this is why there is a sense of emergency about what's going to happen. And the reason why I said that I wasn't going to give you the standard account of how the Fed comes in here is because the textbook explanation would be that, okay, so the Fed steps in, as Mitch also mentioned, they increase interest rates, and through a fairly convoluted process that takes time. Sometimes Mitch said 6 months, some people estimate up to 1 or 2 years, but basically in the end, this intervention cools the economy, it crashes demand, brings wages and profits down, and thereby prices have to readjust. And many people say, well, maybe the Fed in this case is not the right entity to act, because what the Fed really has only one instrument, and that's the interest rate. So the only thing that the Fed can do is cool the economy. And it's already questionable whether you want to cool the economy when there is a supply shock going on, because the problem is not really too much demand, but not enough things being produced. But at the same time, the interest rate instrument is not only slow, but fairly blunt. So if you want to bring prices down, you have to bring all the prices down, not just the ones that are currently rising. And what we are seeing at this point is that some sectors are much more responsible for what's going on. So for example, energy prices are rising, car prices are rising, certain services, especially housing and healthcare, are rising. And so people are asking, or some critics of the current approach are asking, okay, why would we want to crush demand in these places where there's a clear shortage of supply, both in housing, in healthcare, and also in energy and transportation, if we want to cut inflation by shrinking demand in these sectors, what we are really doing is making people too poor to afford some of these very essential things. So people have started to say, well, maybe the Fed is not the best solution. And what I'm going to say now is going to sound very outlandish in the sense that these solutions haven't been proposed for quite a number of decades, but I'm going to also argue that it's actually something that has been tried and something that has worked in the US before. So one of the main arguments that people have brought up is that instead of just cooling down the entire economy, maybe we should go back to controlling prices. Maybe we should have price control on rents. Maybe we should reform healthcare so that there isn't runaway inflation in healthcare, in pharmaceuticals. And people argue that there have actually been very successful examples of this being done in the US after World War II. And so, but what these people are arguing is maybe you should concentrate on the price rises that are actually mostly driving inflation. And of course, this doesn't apply to things like gas prices. But then these people say, okay, so if we are we are concerned about the poor and the elderly, we should actually have some kind of a subsidy system for those people who can't afford energy and gas and transportation at this point. So the argument is that if supply is the problem, we should either hit this problem on the head and help people get these essential goods with government help. We should control prices, and we should expand supply itself, right? So the third part of this argument is, instead of cooling the entire economy down, maybe, and this is of course a longer term solution, but maybe we should raise taxes and speed up the green transition so that the energy price hikes are not hitting us so badly. Maybe we should build more public housing so that housing costs are not in the clouds. And so what I was trying to do here is shed light on the fact that, yes, we always think about the Fed as the primary solution in response to inflation, but that is it's a phenomenon. It's an answer that we have been giving since the 1980s, since the so-called Volcker shock, but that's not necessarily the best solution. And of course, because these solutions that I just mentioned haven't been tried for the last 40 years, there is a large amount of uncertainty about whether they could work in the first place. And I'm not an oracle, so I wouldn't be able to say if they would work, and especially if they worked before the so-called spiral of rising inflationary expectations would kick in. So that's a major risk in this case. But all I was trying to say or show you is that there is actually an alternative set of solutions out there, and we shouldn't necessarily think that the Fed is our only defense against inflation, or even our best defense against inflation. And I should stop there and hand over to Mike. Thank you.
Thanks, Sophia. Now we're going to have Mike Murphy. And I have to mention, Mike's a Rockefeller College graduate, which we're all proud of. And he's also a Maxwell School at Syracuse graduate. So Mike, it's your floor.
Kevin, thank you. Mitch, Sophia, nice to be with you too. And thank you, Julie, Kelly, others for having me. Yes, that's what I was going to start off with too. I'm really thrilled to be here as a alumni of UAlbany, and certainly look fondly back on my days UAlbany. I really like your background too, Kevin. That's real good. I've been 2 years into the pandemic world, and I still haven't got the good background thing going on. Those are really good opening remarks on a nice kind of building off of both Mitchell and Sophia's, with I guess how I'll sort of open this up and look forward more so to questions, discussion, and the time we have. So I'll start off by saying I certainly don't consider myself a monetary policy expert or a Federal Reserve policy expert. Myself, my organization doesn't focus exclusively much on monetary policy. We're a more fiscal policy organization. It focuses more on the federal government's power to spend, and tax, and associated issues surrounding our deficits and our debt. So what I'm going to do is I'm going to try and, I guess, position my remarks more so a little bit on where there's some intersection here between some of the spillover effects when it comes to the decisions to raise interest rates on the federal budget and fiscal policy. I'll touch on that a little bit. And certainly some of what I'm going to say, I think, does dovetail a little bit with what Sophia was just speaking to there as well. So I'm going to make two big points, I guess, and we'll save more for discussion and Q&A. The first big point is the state would probably is assumed to be true or obvious. Yeah, interest rate decisions, they do have spillover impacts into the federal budget, okay? The federal government carries a very large debt. It has a very large national debt of debt held by the public of about $23.6 trillion today. With that debt comes costs to service that debt. Okay. Last year we spent in the fiscal year, I got some numbers in front of me. We're a federal budget group. We have a lot of numbers, so bear with me as I reference a few here. About $330 billion annually in debt interest payment costs last year. Those are projected to grow to about $920 billion in about 10 years, according to the CBO. So in 10 years, about $1 out of every $9 will be spent on interest cost payments at the federal level, in the federal budget. Now that's in spite of, historically for the last several years, we've been historically low interest rate environment. So that's in spite of that. If interest rates on federal treasuries go up on average about 1 percentage point projected over the next 10 years, that would result in an extra $1.9 trillion in interest payments. So there's a interest rate risk there in terms at the federal level. The other thing to be aware of is that at the federal level, our bonds, treasuries, and the maturities on that debt are generally pretty short term. I think it's about 30% of our treasury at the federal level bonds will mature in the next year, 2/3 in the next 5 years, 84% over the next 10 years. So to put it in other words, like we don't have locked in, 30-year fixed, interest rates on what we pay on our debt there. So the bottom line is one spillover impact of what we're kind of talking about here at the Fed, and totally second what Mitch was saying, what Sophia was saying, speaking to too, like this isn't immediate, it's not a one-to-one, it's not an immediate kind of spillover impact, but if we start to increase interest rates as a whole, there'll be some spillover impact into the federal budget just based on the amount we'll have to pay on interest payments. That's exacerbated by the fact we have an underlying debt trajectory itself that's going up over the next several years and decades. Our debt's high on a nominal basis, I said, but as a percentage of the economy, it's about equal to the size of the economy right now, and it's projected to grow forever, right, according to Congressional Budget Office projections. So that is a factor, and I'm happy to get more into that in discussion. So that's one key point. There's some spillover impacts into the federal budget as it pertains to interest rates. But the second point is one that just was spoken to already, but I'll elaborate on it, that monetary policy has historically been, right, the mechanism that we control price levels in this country and inflation. That's what Mitch and Sophia were just speaking to. But, I think it's pretty clear that, fiscal policy has played some role, as was spoken to by both Mitch and Sophia, of contributing to some of the inflation pressures we see today. And I think that while monetary policy is still going to play, I think the key overall role here in trying to figure out how we deal with inflation, generally agreeing with Sophia said, that there's we tend to believe that even though that's the case, fiscal policy can play some kind of role in addressing inflation going forward. Getting the details on that right, there's a whole lot of people trying to think about some of that stuff right now, but we think it can, because to reiterate what was already said a little bit, generally two big factors kind of contribute to inflation. One is the fundamentals of the supply and demand issue going on, and the second is expectations. And fiscal policy can, we think, play a little bit of role on both of those factors. You can figure out how you might be able to dig in on some of the fundamentals there to maybe use the tax and spending power of the federal government to deal with some of those, but also because with action at the federal government level as a whole, both monetary and fiscal, it can send a signal, right, that the federal government is trying to get this under control, which can help, hopefully, with some of the expectations, which is one of the key risks that was being spoken to. So anyway, I think maybe that's a good place to stop. It's probably a time we can get into, but again, great to be with all of you.
Okay, thanks a lot, Mike. Let's start to get into our questions. I like to address every question. The first one, though, I think we've already answered. It says, what is actually causing inflation? So I think we've thrown the ideas out there with that one. Now, here's a critical thinking question about this whole topic. It says, is the current fear of inflation inflated? Anybody have any idea? Is this just made up and not that big of a deal, or is it a big deal, the inflation?
I would speak to that. I think that the fear of inflation is really not overstated. First, I think because there's a psychological element to inflation. If this inflation, if this psychology, inflationary psychology, becomes what's referred to as unhinged, the inflation can spiral out of control. The Fed and Congress need to make sure that this doesn't happen because, as I said earlier, the harm to the poor, working class, and elderly Americans of high inflation is severe. It becomes impossible to pay bills, and choices between things like food and healthcare become even more real. As for wealth inequality, which is implied in the question, it's a gigantic problem that's affecting the divisive politics that we see in America and the economic life chances, the economic mobility of many Americans in a very negative way. So we're close to levels of inequality that we haven't seen for 100 years. And we know how to reverse this through taxation. And it is, in fact, way past time to do that. So what I would say is both are problems, both inflation and inequality. And they should concern Americans in very serious ways. But the solution to inequality is not to let inflation spiral. In the ideal, a soft landing would allow wage increases to continue, which we've finally begun to see increases in wages, and at the same time get inflation under control.
Okay, thanks. Now on inflation, everybody should be watching tomorrow when the Consumer Price Index comes out. That's going to be a big read on this, so we should all be looking for that tomorrow. Now, here's another critical thinking question. This one, I'm just going to read it. It says, are interest rates the right target, or might the extreme concentration of corporate wealth, is that the main culprit, as Robert Reich has argued? Any thoughts on that?
I'm not actually familiar with the full argument by Robert Reich, but in a sense, this is a question whether who is going to pay the price for bringing inflation down, right? And yes. So the argument is that if you are trying to target inflation the same way as they were doing it in the 1980s with the Volcker shock, which was basically one of the few successful ways of bringing really high inflation down, but it came at an enormous cost, that would be making workers pay, because that was the part of a concentrated effect, a concentrated attack on workers' rights and their ability to keep up wage increases. And the inequality that Mitch was just mentioning really started to, so that the difference between the rich and the poor really started to widen from the 1980s after workers' ability to achieve higher wages was crushed, and part of that was the Volcker revolution and the Volcker shock of increased drastically increased interest rates. So the question is, who is going to pay for all of this? And in a sense, you could say, well, maybe this should all come out of profits. And so we shouldn't try crushing wages. We shouldn't come down with the full force of the Fed on the economy. We should actually have corporations pay the price by, not raising their prices in step with the wage increases. But a big question is how that would be achieved, right? And so this is where Michael's point about fiscal instruments comes in. So in a sense, you could, in principle, just levy a tax on corporate profits that are higher, but that might not be the best way to bring inflation down, because corporate profits typically fuel savings rather than consumption, and so therefore they're not going to have this effect on demand that we are seeking with the Fed interest rate. And so what would make sense from a moral point of view might not work so well from an economic point of view. So even if you assume that what's going on, what's driving inflation is really price gouging by profit-oriented corporations, it's really difficult to stop that unless you are willing to go the way that I propose, that you put price controls on certain things. And I already had a comment on that that ends in an eek. So I guess that would not be necessarily a very popular method. But if you wanted to actually go after corporate profits and go after the component of inflation that comes from progressive price increases as corporations are trying to preserve their profits, that's where you would revert to price controls.
Okay, we've got another really nice critical thinking question here. I'll read this one off. It says, to what extent is the Federal Reserve with its loose monetary policy responsible for the inflation? Anybody have any ideas on that? I guess the loose monetary policy, we'll just say the policies they've had over the last, 7 or 8 years. Did that cause the inflation?
But there's no time, so that the timing doesn't work, right? So monetary policy has been loose ever since 2008, and there was a slight tightening around 2014, 2015, but really nothing happened. So neither did the tightening cause a recession or a drop in prices, nor did the rest of the other 14 years really cause inflation in the meantime. So it's hard to argue that immense, and yes, it's true that the liquidity was flooding the markets, but we didn't see inflationary effects before the pandemic ended, before the war, before the jump in energy prices. So Occam's razor would tell me, no, it's not the reason.
I'd be curious what both of your thoughts are on this. So I think I generally agree with what Sophia just said, but I also think it can be true at the same time that the loose, very low interest rate environment for the Fed over the last several years has in some ways made it even more challenging to kind of get us out of this inflation situation that we're in right now. Any movement towards the Fed signaling some of the interest rates has sent the markets into panics over the last, ever since kind of normalizing this low interest rate, loose environment. So I think, Sophia, I generally think I agree with what you said. I think it's also true that the loose policy that they've had is making this even more challenging to try and get it out of it.
Absolutely.
Okay.
So I would just to answer what Mike was saying. So absolutely, I think that the fact that the markets have been operating on this liquidity-rich environment for such a long time makes it very hard to change. And I think that really ties back to the point that you were making in terms of how much harder it is going to be to service the United States debt if interest rates are that much higher. So if you have higher interest rates, much more onerous debt service, and really panicky markets, that's never a good combination. And in that sense, it's not even the United States that is at greatest risk, because the United States, at the end of the day, is not going to go bankrupt. But but the countries that are really at high risk from this are the emerging markets, where all of this liquidity had flooded before. And already in 2014, 2015, what we saw was that when the Fed was trying to tighten ever so slightly, there was a so-called taper tantrum in these emerging markets, where markets were spooked that there would be a lack of liquidity, and they were rushing back into the American markets. And in that sense, if we see a really large jump in the Fed rate, that's definitely going to happen. And then it's going to cause all sorts of crises elsewhere as well.
Okay, here's another really thoughtful question.
Kevin, could I jump in for a second?
Yeah,
Because just the idea of, you know, Sophie's been talking about the idea of price controls, and certainly there's a history of the United States having had some success with price controls. And I think we need to sort of address why it's not even on the table, why we don't hear it being talked about. The fact is that politicians are totally indebted to the corporations and banks for their campaign contributions. And so the last thing they're going to do is tell them that, oh, we want to target the price increases because corporations and banks are going to push back extremely hard. And the last time we had price controls, that dependency wasn't nearly as strong. And in fact, Congress was much stronger than it is today as an institution. So some of this is blamed on the weakness of the institution itself.
Okay. And here's another really interesting question. The questioner says the current situation is artificial, and that's the key word in this. There's a war, COVID, stimulus problems, supply chain. So the question is, if this is an artificial situation, is this a good time to do anything? A real critical thinking question here. Anybody have any ideas? Can we just leave it alone?
I mean, I guess my reaction to that is kind of already, we've spoken about this already, but you know, the reality is inflation is a huge psychological problem. So that's what Mitch was saying before. And it's my point too, what I was saying is like two separate issues that have to be always thought about at the same time. The underlying fundamentals, right? Which I think the questioner is kind of saying, well, those are artificial or at least maybe temporary or whatever. So we don't have to overreact. But then there's the psychological side of this too. And once things get baked into the cake that people think inflation is going to be going up for a while, well, then it starts going up. And then you could have a spiral that gets out of control. And then that's going to be a problem. So you can't, I don't think that psychological aspect of this should be thought of as artificial. I think that's real. And I think that's what people are concerned about, is when and how we cross the kind of Rubicon of those expectations becoming so-called anchored, and therefore, you know, things start to go much higher from an inflation standpoint.
I guess I'd also argue about calling the conditions that are causing the inflation artificial. What does artificial mean? They're real if they have social, economic, and political impact, and they do. So they have to be considered as real and dealt with.
Okay, we have a student loan topic, and I know I mentioned this already. Mike's organization, I was reading about they discussed this last week in the Wall Street Journal. The question is, could you speak about your knowledge of the relationship between the Federal Reserve and student loan debt, including the pause in payment because of the pandemic? Any ideas on that?
Well, since you cited me, I'll take that first. And I'm not going to speak a little bit to the intersection of the Federal Reserve and student loans, because that's not what some of our recent analysis has talked about, although I'd be curious if others have points on that. We've done a little bit of analysis on student loans recently, and some of the things that are being talked about, and its potential spillovers from an inflation standpoint and fiscal policy standpoint. So let me step back for a second. One of the things we were talking about before is like, fiscal policy may play a smarter role and kind of, Sophia's, I'm paraphrasing, but your words, like targeting some different policies, different sectors, places of the economy that makes sense. Well, it does rely on people making smart policy decisions in some areas. And we just feel pretty strongly that there's a policy going on right now that if your goal is addressing inflation, which was being said, it's not exactly the smartest way to do it. So there's been a policy in place since the pandemic, a moratorium on federal student loan payments. And it was just announced in the last couple of days that they're going to extend that for the next few months because they say it's also due to inflation pressures. But here's the reality on some of this, and we have an analysis on this on our website. With unemployment rate amongst college graduates at a like 2% rate, okay, which is near decades low, and the fact that a huge amount of the student loans go to doctors and lawyers. It's not going towards other lower end professions or folks at the bottom end of the income spectrum, let's just say. You know, putting all that money into the economy right now, give that money back to those folks, to me, doesn't seem to meet the goals of sort of either tapering inflation and or trying to target relief maybe to areas for folks where it's most needed. So anyway, that's kind of our, maybe using that one as an illustrative example, I guess, is like trying to do a policy that maybe has some goals, but the reality is from a distributional and or impact on inflation standpoint, might not be the best way to do it, I guess, is our point there. But I am curious if others speak to any intersection between Federal Reserve and student loans.
Well, to add to your point, Mike, if what the questioner's concern is the issue of canceling student debt and what effect it would have for the Fed, the main implication of canceling student debt for the Fed is that student debt's been a huge drag on economic growth, holding back purchases of homes, starting businesses, staying solvent through economic downturns. So as Janet Yellen's talked about when she was Fed chair, canceling student debt would help the Fed maximize employment. So, you know, they wouldn't, for that reason, be opposed to it. And my feeling is if there were inflationary effects from the cancellation of student debt, these are exactly the kind of things that the Fed can handle, you know, reasonably well. But I don't think the effects would be major.
Okay, any other commentary on that question? I know our student loan questions are big for some of our students. We had a couple other questions. I'm just going to mention them, but I think we've discussed them already. It said, what are the hopes from increasing interest rate? I think we've talked about what should happen there. And are there positive, negative, long-term effects? I think those questions we've pretty much answered in the direct presentations that everybody made. Now, there's another question, and this one, I might think it's, anyone can comment on it, but I think it might be more for Sophia. And this question, it gets a little involved. It says, with interest rate increases in the United States, the dollar normally gets stronger. And how does that affect third world countries who are forced to buy commodities in dollars? Any ideas on that one?
I think it's a great question, and it relates to what I was mentioning before, that because the dollar is the world currency, and many countries are not only buying things in dollar, but they are also heavily indebted in dollars. Both the strengthening of the dollar and the increase in the dollar interest rate is going to affect the third world countries very heavily. So my answer is yes. It is a big risk that that there is going to be huge spillover effects. And I mean, I don't want to be all gloom and doom, but it's also going to affect the same countries worst that are already affected by, you know, food price increases from the Ukrainian from Ukraine not being able to export grain and things like that. So it's kind of a perfect storm in a sense. In the last crisis, the Fed has played a really big role in trying to handle the worldwide global fallout from everything that happened. And it actually helped a lot. It helped Europe and most of the developed countries a lot. And that was a historical moment where the Fed said, well, you know, we are actually the central bank of the world currency, so we should behave that way. And we have this responsibility towards other countries in terms of helping them out. And but basically what that meant was bailing out some of the European Union banks who had been indebted in dollars. So actually, this is a really pertinent question. I'm wondering if the Fed this time is going to take the same kind of responsible action, even though this time it's less likely that it's going to be the developed countries who are going to be affected, but the developing countries. So I think this question is spot on. I haven't really thought about it in terms of you know, the other. So I only thought about it in terms of the taper tantrum and increasing interest rates all over the world, but exchange rates might affect those countries in very similar ways. And as I said, those countries are already pretty hard hit by everything else that's going on.
Okay, any other comments on that one?
I think it's a very good question. And the Fed, as Sophie says, did intervene in a very big way and became the world's banker in the 2008 crisis. But that was a financial crisis. And so they were looking at central banks and whole economies crashing. And so they stepped in to try to prevent that. Whereas if the United States goes into recession, the fallout effect will be kind of a slow trickle across the world where people will suffer from the slowdown in the United States. And historically, we haven't done much about that. And so I'm not hopeful that we will this time.
Okay, here's another question. It says, considering there is a shortage of housing in the United States, what role will interest rate hikes play in the decline of housing prices? Any thoughts on that one?
Yeah, I'll take that. It's actually counterproductive, right? So if you raise interest rate, there's going to be less housing construction, partly because the value of already existing housing stock is going to be affected, but it's also just, it doesn't make sense to, construction firms are not going to be able to access loans at affordable rates. So the supply is definitely going to be negatively affected. But at the same time, even if most people are on fixed rate mortgages, it's still going to make their housing costs more expensive, because, for example, they won't be able to refinance like they did before, or if they move, they are going to have to pay higher interest rates on their new mortgages. So actually, it's not. I would say that there are at least two mechanisms through which an interest rate hike makes housing costs higher, not lower.
Well, okay. Then we have another question. It says, Sophie mentioned moving towards universal health coverage as a potential mechanism in addition to price controls in reducing inflation. I'm wondering if she could elaborate on the mechanism. So the simple question is, how will universal health care help us with inflation?
So America spends more, 30% more than the second highest spender in the world per capita on healthcare. So the US spends more than, for example, the Netherlands or Luxembourg per capita. And that's because of the current system with private insurance providers and private healthcare providers. So in healthcare, for the last, especially since the introduction of Medicare, the last 60 years of healthcare has just been about price gouging. And so if there was a single provider and that was the state, then that would take care of that. So it is an incontrovertible fact that healthcare prices are just too high in the United States. And the evidence for that every other developed country spends at least 30% less than the United States per person. And that's not because service is so much better in the US. Sorry, that was the last one was a subjective remark, but actually all sorts of indicators, life expectancy, access to healthcare, years of life lost due to lack of access to healthcare. On all of those indicators, the US is lagging far behind the developed country average. So we are having the worst healthcare outcomes for the highest prices, and that is purely because of price gouging. But yes, universal healthcare is a hobby horse of mine. I just happen to think that it also has to do with inflation.
Okay.
Yeah, can I just add on to that for a second? I mean, I think that, you know, if there's an area where the federal government can step in to really help control prices in a sector, it's healthcare. Because I don't know the percentages offhand, but healthcare is the biggest programmatic spending area in the federal budget. What the government does to set policy there has huge implications across the entire healthcare sector. So I'm not saying here advocating for we need a universal healthcare system to do this, but I am saying that if there's an area where policy can play a significant role, again, it's because of the lag time issues that we talked about before. It's not like they can make a policy decision and vote on it tomorrow, and it's going to impact healthcare prices in the next week. I mean, this would take a little while to trickle through, but healthcare policy is a big area of potential to both improve the healthcare system, to say the least, for a lot of the reasons Sophia just said, control federal government costs, but also can have an impact on price levels in the economy, given how huge healthcare is.
Okay, now here's another question. With the upcoming interest rate increases, I think we all know they're coming. They've already started, as some of you have mentioned. Well, what's the significance of this issue with the $9 trillion balance sheet that the Federal Reserve has? And is that some kind of risk for the economy? Could someone comment on that?
Well, the Fed has accumulated a gigantic balance sheet. That is, starting really in the financial crisis of 2008, it began to grow its balance sheet in ways that it never had before. It was buying, and what that means, for those who don't know, it means that it was buying all kinds of securities that it had never bought before. And they went on the Fed balance sheet, and the Fed was holding them and rolling them over to put money into the economy. And then when the pandemic struck, they went back to the policy they had developed in the financial crisis and bought more securities in order to put more money into the economy. And now they've got this incredibly large balance sheet, and had the things that we've talked about earlier that caused that are causing the inflation not occurred, they would be very comfortable beginning to unpack that balance sheet because they obviously at some point need to, and the economy is growing, and there is room for them to begin to sell off some of the assets they're holding. And they're going to continue to do that as long as the economy grows. So they'll be watching very carefully what the effects of their raising rates are in their decisions about how fast they sell off those assets.
Hey, any other comments on the $9 trillion balance sheet? Okay, we've got a couple minutes left. I kind of had a dual mandate myself to let everyone speak and get all the questions answered, and I think we've accomplished that so far. So does anyone have any last minute commentary they'd like to add to our discussion?
You know, I would just add, I think Mitch mentioned it earlier. I just want to double down on something in terms of whether and how the challenges that we're dealing with right now as it pertains to inflation and how they're dealt with, the broader impacts that could have on the, frankly, already pretty terrible state of our political system and our democracy in general. I think that you do this wrong, some of the drivers that have been exacerbating our polarization, including inequality and wealth inequality, not the only thing, but certainly one of them, can really have these big negative consequences. And I think, so this is an important moment over the next several months in terms of how policymakers at the Fed and at the federal government deal with this, because it's a political system that's already had challenges, and I think this could have an impact on that. So not to have a negative tone, but I think that's such a really important point that Mitch made earlier.
Yeah, I think Mike's point is just so important. The legitimacy of the government really is at a low ebb, certainly in my lifetime, and they need to get this right. Everybody is hoping that the Fed can create a soft landing, because the legitimacy effects could be just the thing that tips us over into even greater disaster than we're already in. So I'm really glad you brought that up.
Okay, any other final comments? I'd just like to add a piece here. I was a young college student at one time. It was a long time ago. And I'm going to go back to 1969. I'm in the business school at the University at Albany. A controversy about the Vietnam War and the economy and all of the money supply, all this was raging. So I took a elective course. It was Economics 350, Money and Banking, all about the Federal Reserve. And I remembered that course from the day I took it. I've been thinking about it every day since. And I really encourage our students here to get involved in this Federal Reserve issue. I think it's really important. If you're going to be in a career over the next 50 years, the Federal Reserve, I don't think it's going away. And I think there'll just be a continuing series of issues that they have to solve. So with that, I'd like to thank everyone for joining our discussion today, particularly our panelists and the students and everyone else. And I think with that, we can pretty much end our session. Thank you, everyone.
Thank you all.